Welcome to our introduction to credit default swaps, brought to you by Canjo.com. Credit default swaps are one of the most complex financial instruments out there, and they have certainly played a pivotal role in the credit crisis of 2008 and 2009. Now, I'm not going to be able to explain all of the details of credit default swaps in this video, but I do want to go through some of the basics and help you understand what it generally is and what kind of a role it tends to play in the economy. I think the best place to start is to break it down into the three separate words. You have credit, default, and swaps. And each of these is an individual term that we'll analyze, and then we'll put it all together. So let's start with credit. What exactly is credit? A credit is basically a loan. Bonds, consumer loans, and mortgages are all forms of credit. As you probably know, the loan must be repaid over a predetermined period of time. So this is how an investor in credit will make money. They will charge interest, and they will also be repaid the principal over an extended period of time. But there is a risk. What if the borrower cannot afford to repay the loan? This is called the probability of default, and there's default risk associated with lending out money. As I mentioned, default is simply the chance, the probability that a borrower might not be able to repay the loan. So if the borrower defaults on the debt, defaults on their credit, then this default would result in a loss of principal for the investor. Now, for some investors, this is fine. They are speculators. But for other investors that are a little bit more conservative, for example, a pension fund that might want to invest in the debt markets, the mortgage markets, they might not feel that this is an acceptable risk for their clients. So what is something that an investor could do to protect against the risk of default? And this brings us to our final term, which is a swap. A swap is a contract to make an exchange in the future if certain events occur. Now this sounds a little bit theoretical and vague, I understand that. But let's actually jump forward a little bit and put all of this together. A credit default swap will swap cash flows. So I will make the exchange of cash flows with another party. That party is called the counterparty in this exchange. And these cash flows are associated with the repayments of the credit. So remember, if I am an investor in credit, I am receiving cash flows of the principal and interest. But this only happens if a default occurs. So if effectively I am entering into an insurance contract, and this brings us to the insurance analogy, which I think can help you understand this a little bit more. Basically, a credit default swap is insurance protection against default of credit. The seller of the CDS is the insurer. They're taking on the additional risk of default. And the buyer of the CDS is effectively the policyholder. They're trying to reduce the risk. In return, the buyer will pay the seller some cash up front, very similar to an insurance premium. So that's the best way to think about it. It's kind of like an insurance contract on the possibility of default on debt. I think that's probably the best way to think about it, but it is a little bit generalized. Credit default swaps are far more complex than this simple analogy illustrates. Let's try to understand why that complexity can actually lead to some problems. Now, credit default swaps are a type of derivative. Derivatives are basically securities that depend on the price of other securities. In this case, here's the relationship. We have the credit value, which is called the underlying security. So how much is the credit worth? And credit will be more valuable if the probability of default is lower, right? And this credit value, the value of the credit will directly determine the price, the value of the credit default swap. So there is a relationship here. The problem is that this relationship is fairly unclear because there's a complex equation with often hundreds of thousands of dependencies and complex inputs and variables. And as a result, it's very hard to figure out how the credit default swap's price will change based on the change in the credit value. So this leads to a lot of uncertainty in the capital markets. If people don't really know what the credit value is worth, they can't really figure out what the credit default swap is worth, and so on and so forth, because all of these derivatives are tied to each other, and it becomes very, very messy. Now, this wouldn't be a problem if the market for credit default swaps was small, but on the contrary, the market is huge. It could be as large as $77 trillion. That's a huge amount of money. In fact, it's larger than the GDP of most countries, including the United States. So that's really scary. If there's a lot of uncertainty about a market this large, you have a crisis of confidence. And that's exactly what's happened in the credit crisis. So I hope this video has helped you understand a little bit about credit default swaps and how they work. For similar videos, I recommend you check out my financial crisis series. I think that'll help you understand some of the events, and you can take this information and tie it in to some of the meltdowns that happened in 2008 and the beginning of 2009. Thank you very much for watching, and for similar videos, please check out my website, www.canjo.com.